Hello, friends. Today we're talking about PepsiCo, ticker symbol PEP, which just hit not too long ago a 52-week low of $56 a share. Analysts are saying that it is a buy with a upside in the next 12 months of about 17%. They just report earning on October 19 and October 10, and year to date they're down 7%. So the question is PepsiCo right now a buy? So that you know, I have a small position of 2.5% in of my portfolio. That's about half a position for me, and I am looking to see what will be my next entry point, or whether I should even consider continue to invest in PepsiCo. This is not financial advice. This is just me doing a little bit of um, educational purposes, exercise in the internet, and see what you guys think about this. If you have certain entry points, if you see that I make a mistake, other than my voice, with assumptions and stuff like that, I would love to hear from you. So just put down in the comments below, and support the channel. That will help me, especially if you like what you see. Just subscribe to the channel, so I will appreciate that. I was looking back at the 2007 2009 recession, since there's a lot of talk about recession, and PepsiCo went down about 37%. And then during the COVID dip, what I like about it is the bounce right back. So I'm not too worried about. It seems like Pepsi more than Coca-Cola. I just finished doing Coca-Cola. It should be in up by the time you're looking at this. So if you would like to look at it, just go ahead. But it just seems like Pepsi is a better position to go through this kind of down turns of the economy, recessions, and stuff like that. And I think that part of that has to do with the portfolio. Coca-Cola is all beverage. Um, PepsiCo also has convenient food, also known as snacks. So yeah, they have Pepsi, they have 7 Up, they have um, Rockstar, Aquafina, Lipton, Mountain Dew, Gatorade. Uh, those are great products, but also they have Doritos, Frito-Lay, Tostitos. So they have Cheetos. They have made it a really nice combination. Actually, whenever we look at the 2021, this is what I have here, 2021 net revenues, but I believe the last one, it's about the same. Actually, 55% of their sales come from snacks, and 45% come from beverages. And their biggest market is United States with 56%, and Canada at 4%. So 60% of their sales come from North America. So I think they're very well positioned. Last quarter, actually last week, they reported earnings and they beat, not by much, but they had a nice beat. And then the next time that they're going to be reporting will be next year in January. However, the last 90 days they have had 10 analysts revision down with revisions down, and 5 with revisions up. So this is why I wanted to look a little bit more into the finances. And when it comes to revenue, the past 10 years, as you can see, it has been growing pretty nice. Sales are going up. Last 5 years, last 10 years is an average of about 4.5%, and that's CAGR. 5 year, it has been 7.8. That's pretty nice to see. When it comes to earnings, They're steady, growing little by little. It seems like about 3.2% in the last 10 years. Um, and in the 5 year, there is that um, uh, negative 7.4, but that's because of this 2018 big earnings report. If we were to take the average, I believe it was 6% when I was checking. 6% CAGR growing. And then they have a nice profit margin of about 10%. When it comes to free cash flow, as you can see, it's very up and down, but it stays between the $4 and the $5.50. So that's reflected on um, the 10-year growth about 1%, and 5 years 3.10%. The margins are pretty close to the 10 of the earnings, so that's pretty good. Book value has been growing in the past 8 years. Um, uh, in the past 5 years have grown about 6%. They have very nice return to equity. In the past 5 years, the medium is 51%. I normally look for about 10 to 15%. Return of equity, return to asset, I like it above 5%. They have 9.5, and return on invested capital, that's about 18%. That's really good. When it comes to dividends, they have been growing pretty steady. Whether it's 10%, 10-year or 5 year, they're about 8 to 7% growth, as you can see. Pretty steady growth. If you're a dividend investor, you will be happy to own PepsiCo. When it comes to debt can kill a company, and the debt has been growing kind of steady in the past 10 year or 5 year average of growth of about 5%. And they're a little high for what I like to see. I like to see it under 5%. I would like them to be able to pay within 5 years their long-term debt, and they're 5.6, so not bad. This is very nice, especially if you're comparing it to Coca-Cola. They are not diluting the shareholders. They have been going, even though it's a little slow, at a CAGR of negative 1% in 10 years and negative 0.5% in 5 years. I don't care. It's going down, so I like that. So as a summary of the growth, we can see revenue is about 7. It's growing about 7.8%. Earnings is really like around 6% if we eliminate that 2018 EPS report. Free cash flow is a little slow at 3.1. Book value at 6% in the last 5 years. And analysts are predicting that it will grow in the next 5 years about 8%. So if we're looking at the historical multiples, I like to use the historical multiple more than just comparable multiple with other companies, because all companies are different. A lot of people like to compare Pepsi to Coca-Cola, and like I just show you, there are two different companies with snacks and beverages for Pepsi, and Coca-Cola is only beverages. So I like to just look back at the last 10 years and what are the medium that the market has been willing to pay, medium multiple when it comes to sales, earning, free cash flow, book value, and dividend. So if you are one of those investors that like to use the trailing 12 months, you should be paying or a fair price for Pepsi will be about $162. I like to use more a 5-year average, just because that accounts for any ups and downs of the market, and it's a little more conservative. So I will be looking at a fair market value based on the historical multiples of about $144. If we use the Fieldtown payback time with a growth rate of 7% of free cash flow, it will be somewhere around $128 to $144. If we're using discounted earning valuation, paying 27 PE and growing it at 7%, we're looking at about $113 to $117 a share. And if we use owner's earnings valuation, then the stock is very overvalued. So what I like to do is I like to take all the multiples, the payback, the discounted earning valuation, the owner's earnings, and put it all together. And if we do that, we should be paying somewhere between $134 to $144. And the stock is at $160. So that is, I believe, it's a 10%. It's about a 12% difference. 15? Yep. About a 15% overprice. What I would like actually to buy it for me again, it will be somewhere around in the 10% margin of safety, somewhere around between $120 and $130. The reason why my margin of safety is so low is because I already make assumptions in the payback, in the margin of safety of 15% return discounted, and also because Pepsi has a really nice moat, and I'm okay with not having so much margin of safety. So that is what I'm looking at. Once again, this is not advice, financial advice. It's just me ranting on YouTube. I would love to hear your feedback, and I hope to see you on the next video. Bye.